Passive investing. For years, it's been seen as the smartest, simplest, and safest way to build wealth. It has absolutely taken over modern finance. But what if that incredible success story has a hidden side? What if the very thing that made markets seem safer is now creating a whole new set of risks, hiding right in plain sight? Well, let's peel back the layers on this financial revolution.
So here's what we're going to cover. We'll start with just how massive this passive revolution has become. Then we'll dig into the really fascinating stuff, what it means for corporate competition, and maybe even more importantly, the stability of the entire market.
All right, first things first. To really get what's going on, you have to appreciate the sheer scale of this shift. This isn't just a little trend, it's a complete rewiring of who owns what.
Get this. By some counts, passive strategies now control over half of the entire global stock market. I mean, just stop and think about that for a second. More than half the money out there isn't trying to pick the next big thing. It's just buying everything. This isn't some niche strategy anymore. It's the dominant force, plain and simple.
You know, for years, the whole active versus passive debate seemed pretty much over. The argument was simple. Passive is cheaper, and on average, it does better. Case closed, right? Well, maybe not. That simple answer misses a much deeper economic reality.
And this is where things get really interesting. On one side, you have this incredibly simple and powerful idea from William Sharpe. His math basically says, after you subtract fees, the average active manager just can't win. It's compelling, and it's what won over the public. But on the other side, you've got this more complex economic model, the Grossman-Stiglitz equilibrium. And it says, well, hold on a minute. For market to work, you need active managers doing the hard work, the research, to figure out what things are worth and keep prices honest. It suggests there has to be a balance, not a total knockout.
And that question right there, that's the core paradox. See, passive investors are what we call price takers. They don't set the price, they just accept it. They have to, because they're just buying the index. They completely rely on active investors, the price makers, to do all the homework. So what happens when that pool of price makers starts to shrink? Well, two huge problems start to pop up.
Okay, so problem number one is this massive, almost invisible, concentration of power. And it has the potential to totally change how companies compete with each other. This is the issue of common ownership.
So what exactly is common ownership? Well, when you buy a big S&P 500 index fund, you're not just buying Apple or Microsoft. You're buying a piece of pretty much every major company. That means the huge firms that manage these funds, think BlackRock, Vanguard, State Street, they end up owning massive chunks of companies that are supposed to be fierce competitors, like owning a big piece of Delta, United, and American Airlines, all at the same time.
This analogy just nails it. Seriously, if you owned the top 3 coffee shops in town, would you want them to get into a brutal price war that destroys your profits? Of course not. You'd want them to play nice. Well, that's the exact same dynamic that's now playing out across entire industries, where the biggest shareholders are the same for all the major players.
And look, this isn't just some abstract theory. Research suggests we can see it happening in the real world. Maybe executive pay plans get structured so they don't reward aggressive head-to-head competition. Or maybe shareholder votes start looking suspiciously similar across an entire industry. It's gotten so serious that even antitrust regulators at the FTC and DOJ are starting to take a very close look.
And we can actually measure this. Economists have a tool called the HHI to see how concentrated a market is. Now, using that traditional measure, the US airline industry looks pretty concentrated. But when you use a modified version that accounts for this common ownership thing, the MHHI, well, the picture changes dramatically. The industry goes from looking highly concentrated to nearly twice as concentrated. We're talking near monopoly levels.
So that's the first huge issue, less competition. But there's a second one, and it's all about whether the rise of passive investing is making our entire market system, well, more fragile.
Let's go back to this idea of price takers. Passive funds are the ultimate price takers. They have to buy when money flows in and sell when money flows out. It doesn't matter if a stock is cheap or ridiculously expensive, they're just following mechanical rules. It's the active investors, the price makers, who are supposed to act as the shock absorbers, buying when things are cheap and selling when they're expensive.
This sets up a kind of dangerous chain reaction. As more money piles into passive funds, the pool of active traders just keeps shrinking. That means less capital, less brain power, is being dedicated to actual price discovery. The market becomes what economists call inelastic. It's a fancy term, but all it really means is that there's less smart money around to buffer the shocks. And the result? Now, even a relatively small flow of money can trigger these huge, outsized price swings.
So what you're left with is a market that is structurally more fragile, more prone to these sudden bursts of volatility. And the biggest stocks in the index, they get hit the hardest because they have to absorb the biggest chunk of these mechanical flows. Sometimes those flows can completely overwhelm what's actually going on with the company's business.
Okay, so with all of that on the table, what does this mean for investors? What does it mean for the future of the market? It's pretty clear the rules of the game have changed and we need to adapt.
So if you're trying to navigate this new world, you have to acknowledge these new risks. You've got this heightened volatility, which means good old-fashioned diversification is more critical than ever. You also have to accept that sometimes a stock's price might be moving because of massive fund flows, not because of its quarterly earnings. And finally, with all this concentrated power, you should absolutely expect regulators to get more and more involved.
And this brings us to the ultimate, beautiful paradox of this whole situation. This quote from Cliff Asness just sums it up perfectly. As the market becomes more distorted and maybe less efficient because of all these passive flows, it might actually be creating more opportunities for the skilled active investors who are left. They're the ones who can spot the craziness and take advantage of the mispricings that passive investing creates.
Passive investing was supposed to make markets safer, more democratic, more efficient. But as it's grown to become this unstoppable force, it might be creating the very risks it was supposed to get rid of. It really leaves you with a final, lingering question. In a market now dominated by flows, has the index itself become the single biggest risk of all?
This is not financial advice.